Good morning. These are the things that matter most for the U.S. pre-market. Nvidia is no longer just a single earnings event. It is the proof test for the entire AI infrastructure trade. Treasury yields and Fed credibility are back in the market's risk model. Consumer demand is splitting between value pressure and premium resilience. And the hidden mechanism is whether AI spending can move from chips into power, networking, and control systems without breaking margins. The central market question is simple. Can Wall Street keep paying a premium for AI growth if the funding, power, and credit layer underneath it is becoming more expensive? Start with Nvidia and the AI capex test. Ahead of the next earnings catalyst, the market is not only asking whether GPU demand is strong. It is asking whether hyperscalers, data center borrowers, and AI infrastructure suppliers can finance another leg of spending at attractive returns. That matters because a narrow Nvidia rally is one thing. Confirmation from power equipment, networking, cooling, cloud margins, and credit-sensitive infrastructure is a much broader test. The cleaner side is Nvidia, Microsoft, and Broadcom if orders, margins, and capital discipline all confirm the same story. Pressure sits with weaker AI labels, highly levered data center funding chains, and software names that sell AI ambition without near-term monetization. For private investors, the useful filter is whether the AI trade is being confirmed by cash flow and financing quality, not just by the most visible stock on the screen. Second, rates and central bank credibility are becoming part of the equity story again. When investors debate Fed independence, fiscal pressure, and long-end Treasury supply, the transmission is not abstract. It reaches discount rates, bank balance sheets, housing-sensitive equities, and every long-duration growth multiple in the Nasdaq. In plain English, Wall Street can still like growth, but it becomes less forgiving when the risk-free rate refuses to disappear. Potential beneficiaries sit with cash-rich megacaps and financials that can handle higher rates. Pressure sits with small caps, regional banks with funding sensitivity, real estate, and long-duration growth stocks if yields climb faster than earnings expectations. The private investor takeaway is to watch TLT, the two-year yield, and regional banks together. If they disagree with the equity rally, the tape is more fragile than the index headline suggests. Third, the consumer signal is split, not broken. The market is seeing value pressure in goods and discretionary retail, while higher income services, travel, and selected premium categories can still hold up. That distinction matters because a weak retailer does not automatically mean the entire U.S. consumer is failing, and a strong airline or premium brand does not prove the average household is fine. The cleaner side is with companies that have pricing power, loyal demand, and less inventory risk. Pressure sits with weak discretionary retailers, apparel, footwear, and any company that must discount to defend volume. For private investors, the filter is to separate experience demand from goods demand, and to ask whether margins are protected without assuming one consumer story explains every stock. Fourth, the underappreciated story is the AI infrastructure second layer. If the market keeps funding AI, the spending does not stop at chips. It moves into power, grid equipment, networking, cybersecurity, data center controls, and operational software. That is where the next confirmation can come from, not as a replacement for Nvidia, but as proof that the build-out is becoming real economic infrastructure. The cleaner side is with power equipment, networking, and security suppliers that can show orders without margin collapse. Pressure sits with AI platforms that need enormous infrastructure but cannot prove returns. The private investor filter is simple: follow the bottlenecks. If power, networking, and security keep tightening, AI demand is broader than one earnings print. Here is the stock-led watch list for today. Nvidia, Microsoft, and Broadcom test AI proof beyond one ticker. TLT, JP Morgan, and regional bank ETFs test whether rates are confirming or fighting the equity move. Amazon, Nike, and United test the split consumer. Eaton, Vertiv, and Arista test whether the second layer of AI infrastructure is still gaining power. Market bias, selective constructive, but not complacent. The bullish version is AI demand confirmed by margins, cash flow, and infrastructure orders while rates stay contained. The bearish version is a narrow megacap rally sitting on top of rising funding costs, weaker consumers, and more fragile credit. The mistake to avoid is treating every AI headline as the same trade. Today, the useful question is not just who grows fastest. It is who can finance growth, protect margins, and benefit from the bottlenecks that the rest of the market still underestimates. That is the U.S. pre-market brief for Wednesday, August 26, 2026. Watch confirmation, not noise. Research context only. This is not investment advice, not a trading recommendation, and not personal financial guidance. No targets, stops, sizing, or portfolio instructions are provided.